Welcome back to the channel, where we dive deep into the fascinating world of hard-to-borrow stocks and the mechanics behind potential short squeezes. Today, we're putting a specific spotlight on HCWB at HCW Biologics Inc., the clinical stage biotech firm that's recently landed on our screeners due to some intriguing data points. Before we jump in, please remember this important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. HCWB, or HCW Biologics Inc., operates in the critical healthcare and biotechnology sector. This company, with a current market cap of about $7.02 million, is focused on discovering and developing novel immunotherapies, particularly for chronic inflammation and related diseases, with lead products like HCWB and HCWB40. Looking at recent price action, HCWB has shown some life, up plus 1.81% today and plus 1.58% over the last 5 trading days, though it's still down significantly, minus 63.77% over the last 30 days. Volume has been relatively low, with today's volume at 25,800 shares compared to a 30-day average of 155,447 shares, indicating a relative volume of just 0.2x average. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why should you care? When a stock is shorted, investors borrow shares and sell them, hoping to buy them back later at a lower price for profit. To borrow these shares, they pay a fee known as the cost to borrow, or CTB. This fee is typically annualized, and when demand to short a stock is high, but the supply of shares available to borrow is low, this fee can skyrocket, often exceeding 100% annually, sometimes even much higher. A high CTB indicates that short sellers are either very confident in their bearish thesis and willing to pay a premium, or, critically, that the supply of available shares is becoming extremely scarce. Why the stock is hard to borrow right now. Now, let's talk about HCWB's current situation. Our data shows an annualized cost to borrow fee for HCWB at an astonishing 679.4%. Highlight number even more notable is the CTB momentum, which has surged by an incredible plus 247 percentage points over just the last 5 trading days. This rapid increase suggests a significant shift in the cost dynamics for short sellers. Show chart, CTB percentage. Currently, there are only about 100,000 shares available to borrow, against an estimated float of 1.4 million shares. This combination of a rapidly increasing, extremely high CTB and a relatively small number of available shares to short has given HCWB a composite squeeze score of 61.6 on our internal 0-100 scale, which flags it for close observation. Squeeze mechanics explained. When a stock becomes hard to borrow with fees like these, it puts immense pressure on short sellers. Every day they hold their short position, they are bleeding money in interest payments. If the stock price starts to rise, these short sellers face a double whammy: losses on their position and escalating borrowing costs. This can force them to cover their short positions, which means buying shares back in the open market. This buying activity adds demand, driving the price up further, which in turn can trigger more short sellers to cover, creating a self-reinforcing upward spiral known as a short squeeze. It's important to remember, though, that a high cost to borrow doesn't guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will eventually fall, even if they have to pay a steep fee in the interim. Dilution risk check. One critical factor we always examine for potential squeeze candidates is dilution risk. Dilution occurs when a company issues new shares, increasing the total number outstanding, which can push down the price per share and negate any squeeze potential by simply adding supply. For HCWB, our checks show no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days. This absence of recent dilution is a positive signal for a squeeze thesis, as it means there aren't immediate, known headwinds from the company issuing new shares. Recent reverse split watch. Another key point for HCWB is its recent reverse stock split. The company executed a 1-4-6 reverse split on June 30, 2026, which was just 14 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price, often reducing the overall float available for trading. Historically, many microcap stocks, particularly in the biotech sector, tend to see renewed volatility or even a price pop within about a month after a reverse split, as the share count adjusts and new trading patterns emerge. This is a pattern observed in some names, not a guarantee, but HCWB is currently still within that typical duration window, which adds another layer of intrigue to its current hard-to-borrow status. Again, a quick but crucial reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For HCWB, as an educational example, here's what astute traders might watch. Keep an eye on the cost to borrow fee as it continue to climb or stabilize at these elevated levels. Monitor the shares available to borrow. Any further decrease from the current 100,000 shares could tighten the squeeze even more. Significant increases in trading volume, particularly above its 30-day average of 155,447 shares accompanied by positive price action, could signal increased interest. Also, consider the post-reverse split timing. Any news or catalyst from HCWB Biologics Inc. itself, related to its immunotherapy developments, could ignite further volatility. HCWB Biologics Inc. HCWB presents a fascinating case study in the hard-to-borrow landscape, with its extremely high and rapidly accelerating cost to borrow, lower shares available, a recent reverse split, and no immediate dilution risk. While a high CTB is certainly a red flag for short sellers, it does not guarantee a short squeeze. It's a complex interplay of market dynamics, investor sentiment, and company-specific catalysts. Always approach such situations with caution and thorough research. If you found this deep dive valuable, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other stocks you'd like us to investigate.